Hello, oracles. Well, we've got fear gripping the market at the moment. We have so many things that are going on around the entire world on a macro basis that the market is just kind of preparing itself for the worst. So we've been seeing the fear greed index slipping into fear. We'll take a look at that in a minute. We've got questions about recession coming out. The Som indicator has hit the point where it has been 100% accurate in indicating recessions. That just got triggered. We've got the election turmoil that's going on at the moment, and we have potential war going on where Iran has attacked Israel. The US is going to be supporting Israel. Who knows what's going to be happening there? But very similar to what we saw with Ukraine and Russia, we can see a lot of uncertainty in the market on top of the recession fears, on top of the election. That's a lot of the reasons why we've been seeing all of this sell off going on recently. So the question is, from an investor standpoint, what do you do? The first thing you need to ask yourself is, are we going to get through this? Because if you don't think we're going to get through this, none of it even matters anyway. So are we going to get through a recession? Historically, we always have. Are we going to get through war? Historically, we always have. Are we going to get through the election? Historically, we always have. So if you're going to look at it from that perspective, we are most likely going to be getting through all of this. How long is that going to take? That is completely uncertain. How low are we going to go before we start to come out of it? Also uncertain. So today we're going to discuss some of the things that you can do to prepare for all of this. Historically, what has happened in the past where people have garnered significant wealth from times like this, and what you can do to get yourself in a position where when we come out of it, you'll be able to grow your portfolio significantly and come out much more wealthy on the other side. So we'll get into all that in just a minute. If you like this kind of content, please hit that like button and subscribe to the channel. All right, so we've got the fear and greed index currently sitting at 27, which is fear. We are pushing closer to that extreme fear. Now, when we were going through 2022, we saw this kind of fluctuating between extreme fear and extreme greed as it dipped all the way down. It was sort of like a giant year of dead cat bounce, especially when it came to the tech sector. And we saw all the Magnificent Seven, all the tech stocks, all of those bouncing down hard in 2022. And we fluctuated between the two, between extreme fear and extreme greed. I don't know if this is how it's going to play out this time going into a potential recession, but we'll take a look at some things that have happened historically to kind of give us an indication as to what we might see going forward from here. All right, so now we're going to go through all of these different fear factors that we've got going on at the moment between recession fears, the election that's going on, and the turbulence in the Middle East between Iran, Israel, and all of that going on, and take each one piece by piece to determine what is going to happen, how long it could play out, how hard it could be, and what we can possibly do along the way to invest to improve our portfolios. So the first one we're going to look at is recession. We just had the Som Rule get triggered. We'll take a look at that in a moment and what that means. And recession, we've been talking about it for a while now, and it's a matter of, historically, we had Adam on the channel about 2 years ago discussing exactly how historically things play out. We are now seeing it all playing out exactly. We said when the Fed starts raising rates, the market comes down significantly. When the Fed pauses rates, you see the market take off and go onto a massive bull run. Then when the Fed cuts rates, you end up seeing the market coming down. Now, it's not because the Fed cut rates that the market comes down, because logically you would think, well, if the rates come down, the market should go up. But the reason the rates come down and the Fed cuts rates is because there's something going on in the macro environment that's causing the Fed to have to cut rates significantly, because raising the interest rates up have caused, tightening of the market. And because they use such lagging indicators, by the time they actually make a reaction, it's oftentimes too late. So then they have to kind of speed up their actions. Most recently, before this past week, we thought that we were going to be getting a 25 basis point cut in November and another 25 basis point cut in December, potentially, with a total of 50 basis points. Now with the Fed coming out, seeing the jobs report that's coming out, the Fed indicating that the next meeting they're most likely going to be doing a cut, that is in September, where they said they did not want to do it in September because they didn't want to make it look like it was going to be anything political. They were intentionally trying to wait until November. The fact that they're now looking at doing September tells me that that jobs report that came out, the Som indicator hitting what it did, kind of spooked the Fed a little bit, and they're trying to get in front of this before it gets really bad. We also have JP Morgan and Citibank thinking they were going to see a 50 basis point cut in September, a 50 basis point cut in November, and a 25 basis point cut in December. That is significantly higher than what we had previously. So looking at that, that is telling us that The economy is sliding away from the Fed and where they wanted it to be, and they're going to have to play catch up. So, taking a look at the Som Rule, what is the Som Rule? More precisely, the Som Rule signals a recession when the 3 month moving average of the national unemployment rate rises by 0.5 percent points or more relative to its low during the previous 12 months. And so, looking at the indicator here, we are at a 0.53 for July, and we have been moving up on a gradual pace here ever since 2022. It's just been creeping up and up and up. We had a little dip here in January of 2023. Then it's been climbing again. And then in January of 2024, it dipped down again. So it seems like in the Januaries, it dips down and then continues to climb. So if this recent trend is going to continue holding true, we are going to be looking at a push up for the next 5 months. And that could be a strong indicator that a recession is here and could be getting worse. And now when you look historically, this is 2020, obviously the pandemic where everything got shut down. But you go back to where we had the great financial crisis, it climbed up significantly. We got here at the peak at 3.9. Are we going to get that high this time? I don't know. Some people are talking about an AI bubble. I don't think if we are in an AI bubble that is going to be anywhere near as bad as the housing bubble. But, looking at how these things have climbed before, it was pretty rapid and went up. We've been on a steady incline for a while. So looking historically, we really haven't seen anything where it's been on a steady incline. Everything was pretty much a rapid shot up. So based upon what I'm seeing here in the charts going all the way back to 1960, we haven't seen anything on an incline like this. So is this something that the Fed can actually catch and kind of level itself off and come back down? Or is this just the start of something that's going to be significantly higher and shooting us up closer to what we saw during the housing market crash? We'll have to see as time plays out. And so now, as it is with any recession that we have had in the past, we have gotten through it before. We also have the 10-2 yield curve about to revert. We're pretty close to reverting now. We've been inverted for one of the longest periods we ever have been. Historically, when the yield curve inverts, that's an indicator again that we are going to be getting a recession. It doesn't happen during the inversion. It's typically when it reverts that we end up getting that recession that comes forward, because now everybody's kind of questioning the short-term rates and they're looking more long-term past the recession. So that's another indicator that we are looking at here as well. So those two things, signs that we've been seeing along the way, just pointing to what our conviction was, is a recession is coming and what we need to do to prepare for it. So if you guys have been following me for a while, you know that I've been saving up cash. I've been kind of building my cash stockpile a little bit more and more and more. So my overall cash pile is a little over 15%, but that is all of my cash entirely. When you look at just my portfolio, I'm at about 4.3% cash. It's fine by me just because I don't have a very large portfolio. When it comes to just my stocks and cash available for the stock portfolio, I'm right around $52,000. So for that, I'm just kind of leaving it at that because it's such a small portfolio. I want to have some cash to be able to jump in when there's opportunities that present themselves, but I also want to be invested. When you go back and look at the dot-com bubble crash, when you look at the housing market crash, any other recessions that we've had in history, typically people just have their money in a 401k. They don't even think about it. Those have all done extremely well. Just holding through that, leaving drip on if you have dividends. That's your dividend reinvestment plan. So when your company or ETF pays out a dividend, you just reinvest it right back into that dividend or company or stock. So when you do it that way, you're just kind of buying more when it's low. So what is the strategy of the stock market? Buy low, sell high. So if you're going to be in a recession and the whole entire market's going to be pulled down, that's the time you want to buy. So if you just have something and you're doing a hold, set it and forget it type strategy, especially in a 401k, you're naturally just buying more when the stock market's low and you don't even know it. So that's why a lot of 401ks have done very well over the last 15 years. Obviously, take out the COVID crash that was going on at that very specific time. But otherwise, prior to that, very, very well. And even most recently coming out of it, the 401ks have done extremely well. So the same holds true for your regular portfolio. If you've just been buying and holding and letting things drip right through it, you're theoretically buying at a much lower price. So if you have conviction in the companies or ETFs that you're holding, that they're going to be coming through this and they're going to survive this and not go bankrupt or not fold up entirely, as long as you're confident on that, these are the times to buy. These are the times that, again, we don't know how long it's going to be. We don't know how deep it's going to go. Is this just the beginning of the market pullback? I do think it's just the beginning of it. I do think we have a lot further to go since we just got the Som Ru triggered. We just got word about the Iran-Israel situation kind of escalating, and we haven't even really hit election season, where historically September and October are really the worst 2 months. We haven't even got to that point yet. So we could be looking at a potential, early November that could be a sign of maybe kind of getting nearer to the bottom. So I still think we have a lot of downward pressure to go. I don't think it's going to be a straight downward line. I think we're going to see some ups and downs and fluctuations. People buying the dip when it's low, kind of pushing the market back up, taking some profits, and then it dipping lower. Could be a very similar dead cat bounce that we saw in 2022, but it might be even uglier. So those are the things I'm paying attention to. And honestly, I'm not going to be deploying cash. I'm still going to be building up that cash position until I see a clear indication of, some bluer skies ahead coming out of this. Then I'll start working on deploying more cash. I'll go over my entire strategy at a later date in a different video, but I'm just going to continue adding cash, but I'm also still adding to my portfolio. My strategy and the way I set up my spreadsheet kind of just indicates to me which ETFs and stocks I should be buying based upon what's pulling down lower, and I can still maintain my cash balance and grow that as well at the same time. So kind of playing both ends of this, where I'm building the cash and still investing in the market when there's dips. Again, I'll make a whole separate video for all of that. So when it comes to the recession, that's it. If you guys think that we're going to be getting through the recession, however long it's going to be, then obviously investing during these times is where wealth is going to be born. As Warren Buffett has said in the past, fortunes are born during bear markets. Recessions always lead to a big bear market. That's when your fortune is going to be born. It's not like your portfolio is going to look great at that time. Those are the opportunities that you can buy your favorite companies and your favorite ETFs at a massive discount, so that as we come out of it and they grow, you're basically buying near the bottom. And then as it grows up from there, you're going to have significantly larger portfolios because of that. All right, so the next thing we'll take a look at, and the next two are going to be much quicker, is going to be the election that's going on. Obviously, we already know now at this point that Joe Biden has stepped down from the presidential race going forward. Kamala Harris is going to be taking over as the Democratic nominee for the presidential race. She is going to be head-to-head against Trump. Those are the top two contenders at the moment. We do have RFK in there. But when it comes to the presidential election, there's such a dichotomy between the two parties right now. I discuss a lot of different things on social media with other people. I try to stay out of politics altogether, other than, just kind of correcting some misinformation that's out there. Otherwise, there's it's such an ugly battle right now, and there's so little compromise, and nobody's willing to see the other person's side. And you guys can have your own opinions on whatever it is. I stay back kind of as an observer for all of this and kind of see what's going on from an outsider's perspective. And this is what I'm seeing going forward. And it's going to be no different than what we have had in the past, no different than 2020, no different than 2016. I think things have gotten probably a little more drama filled over the last few elections. But realistically, we're going to have a lot of drama that's going to happen over the next 2 months. Obviously, we've had drama with, Trump getting shot at. We've had a lot of different stuff going on there. The questions of, is Biden even in a place where he can still continue being president, him stepping down from the race? Lots of drama already unfolding. We haven't even gotten through August yet, just started August. It's only going to get more drama filled. That drama leads to uncertainty. The market does not like uncertainty. So that leads us to believe that we are going to seeing a much larger pullback in the market because of all of the uncertainty. Again, we have the election in early November. So once we get clarification of that, historically, that's usually when we see the market rally from there. We know who the president's going to be. Typically, one side or the other is going to be favoring, a certain sector or not when it goes forward. So at that point, you would buy, stocks that are going to be favored by that party. And that's when you see the market start to push back up. But everything will end up going up after that historically. Obviously, things could be different with the potential recession that we're looking at and the potential war that we're looking at. So just because we have seen that historically does not mean it's going to happen again. But again, historically, an election year, we have seen the market go up significantly. We have seen that go up significantly already. So we could theoretically pull back for the rest of the year and still end up for the entire year. Just remember that. So the last piece is going to be Iran and Israel. So we had the leader of Hamas get killed over the last week. And that there is going to be triggering, obviously, a lot of turmoil that's going on. The US has already indicated that they're sending some troops and support over to Israel during all of this crisis. So who knows if it's going to escalate, but we know what happened when it was Israel and Palestine, what was going on there. didn't get a lot of market reaction to that specifically. You thought that maybe we would see some, disruption with oil stocks, didn't really see a lot of that. This could be significantly higher than what we saw between Israel and Palestine. Because of that, we can see a lot of turmoil. We can see some oil issues going on. And that's another piece when it comes to recessions is when you see oil prices spike, that could happen if we have a lot of Middle East turmoil going on. You all of a sudden get, oil embargoes. You start getting shortages of oil. We're not getting the oil that we want. The US has done a better job of producing our own oil. However, that could still cause a little bit of turmoil and uncertainty over there as well. You have oil prices and gas prices spike. That is another indicator that pushes us toward a recession. That one there is just something to pay attention to and see what's going on. Obviously, we don't want it to escalate. I wish we didn't have war, but unfortunately, that's how humans are sometimes, especially when it comes to leaders who want power. But anyway, that's what's going on. That's the reality of what we're facing. So from an investor's perspective, things to pay attention to are going to be oil stocks going on, what's happening with all of that. And if oil prices do start climbing up because of this, start paying attention to even more recessionary indicators happening and what's going on there. So between the election uncertainty, especially about what's going on with the war and how, each candidate's going to handle what's going on with the war, and then all of that going on, leading to us to a potential recession, we had more bankruptcies getting filed in the past year than we've had in the last 13 years since the great financial crisis. So these bankruptcies going up, that just means a lot of unemployment, as we have seen from the Som Ru indicator. So you see a lot of that going on. If you get into a recession, you see oil prices going up. That could lead to a lot more bankruptcies, especially in small cap Russell 2000 stocks. You can see a lot of that happening. More bankruptcies, more unemployment. That unemployment spike goes up higher and higher and higher. That means that everything is going to go on. That means GDP is going to end up coming down. That means that earnings across the board for companies are going to come down because they're not going to have the same sales. People who don't have jobs aren't going to spend money. So when you're looking at what to potentially invest in, this is why value stocks are so big to Warren Buffett and Berkshire Hathaway, because value stocks typically do very well in recessionary times. So you've already seen stocks like Procter & Gamble and McDonald's pushing up a little bit over the last week, whereas big tech and everything else has been pulling down. You see that happening because those are some safe havens and plays to be in. Now, obviously, with everything going on, there may not be anything that's going to be safe. Cash, maybe, but if we're going to have interest rates coming down, that means that high yielding savings accounts aren't going to be paying out what they used to either. Maybe going into gold is the way to go just to kind of wait it out. But honestly, just sitting in cash isn't a terrible idea, especially if you're looking to deploy that into different stocks and opportunities that you see that are out there in the market. Maybe at the same time, we're going to see the housing prices coming down. You go into a recession, people can't afford houses either. People are going to end up going on defaulting on houses. You're going to see a lot of houses that are going up on foreclosure out there. I've been looking at real estate in Kansas City because that's where my son is going to college. And I've been getting emails constantly, probably 20 a day, of new listings and price cuts in the area. It is insane what's going on just in that very specific area. And you guys can let me know in what areas you live if you've been seeing something very similar. But just to see that kind of market with the housing market out there, with the recession possibly coming, that could get even more drastic. So you may have opportunities to buy some real estate if you have that kind of cash sitting on the side. So just some ideas. Again, you guys need to do your own due diligence and research, do what's best for you and your portfolio and your investing style. But these are just some ideas of what you could possibly do during what we could be coming up to maybe the next, 6 to 12 months. If we're getting into a recession, potential war, the election, once that ends, should be fine after that. But how is the next president going to handle the recession that we could be in? How are they going to handle what's going on with the war? Is that war going to actually transpire? Are we going to get any effects from that? Lots of uncertainty still out there. Again, this is why the market tends to sell off a bit and take a step back and put money in cash on the sidelines just to kind of see. Let's get some answers to make a determination as to when we want to actually invest. What do we want to invest in? So those are just my thoughts on all of that. You guys can let me know your thoughts in the comments below as well. And just want to let you guys know, sorry for no video last week. I was in Nova Scotia with my son. So we spent a lot of time out there having a great time bonding. And then next week, I'm going to be in Kansas City, moving him into college. So going forward from here, my plan for the channel, once he moves into school, is going to be, I'm going to be putting out 2 to 3 videos per week at minimum. If I can do more and I have time, I'll do more. But I'm going to be doing 2 to 3 a week. I'm going to be doing one dedicated specifically to Tesla because I know you guys, most of you on here, are huge Tesla fans. But I'm also invested in so many other things in life. When I started this channel, it was based upon investing in everything in life when it comes to stocks, real estate, adventure like I did with my son, spending time with family and friends. So things like that. So I want to kind of broaden the horizons on this a little bit. So I'm going to share more about what I have in my entire portfolio with you guys, diving into each one of the ETFs and stocks that I have, so I can kind of share with you guys what I've been investing in, and you guys can then take it from there, just to kind of give you some information on those. But I'll do a dedicated Tesla one per week. I'll try to add Tesla into a broad, general kind of market-wide macro view, sort of similar to what I did today, as well on a weekly basis. And then I'll do something based upon other stocks and ETFs that I have in my portfolio, just to kind of broaden everything out, because I know some of you also invest in other things other than Tesla. So I want to be able to broaden that out. So that's all I've got for you guys today. Thank you so much for watching. I appreciate all of your support. Have a great one.